Watch closely when a stock rallies with enthusiasm, volume expanding, then suddenly stalls at an arbitrary price level with no news, no obvious resistance. The crowd sees continuation. The professionals see something else entirely. Massive absorption occurring above current prices. This invisible wall isn't random, it's the composite operator quietly distributing their holdings to eager buyers. Miss this signal, and you'll be holding the bag when support evaporates. For example, stock XYZ rallies from 45 to 50 May 8 on strong volume over 3 weeks. At 50 May 8, it attempts to push higher 4 separate times, each with heavy volume, but minimal upward progress, closing near session lows despite the buying enthusiasm. Price keeps returning to $56, never breaking through. This isn't consolidation, it's distribution. The smart money is selling into strength while retail traders interpret the tight range as a bull flag. In my years of tape reading and market observation, I've witnessed countless instances where well-meaning speculators found themselves trapped at price levels that appeared to offer no logical resistance. They studied their charts, found no previous supply zone, saw no fundamental reason for the halt, yet their stocks stopped advancing as if striking an invisible barrier. This phenomenon is not accidental, it is engineered. The composite operator, that syndicate of powerful interests who can move markets through coordinated action, does not announce his intentions. When he has accumulated a substantial line of stock at lower levels and successfully marked prices higher, he faces a critical problem: how to liquidate his holdings without collapsing the very market he has carefully constructed. He cannot simply dump his position. The sheer size of his holdings would overwhelm all bids and drive prices down precipitously, denying him the profits he seeks. So he employs a more sophisticated strategy. He selects a price level, often one with no obvious historical significance, and begins his distribution campaign. This becomes the invisible wall. Observe the tape carefully when price approaches this zone. You'll notice something peculiar. Substantial volume accompanies each upward thrust, yet price makes minimal headway. The stock may trade 500,000 shares in a session, yet close only 25 cents higher than it opened. Compare this to the earlier rally phase, when 200,000 shares might have produced a $2 advance. The mathematics reveal the truth supply is entering the market in enormous quantities. The composite operator is patient. He allows the stock to rally toward his distribution level, tracking the optimistic crowd who see momentum and wish to participate. As they buy, he sells. The stock strains upward, meets his selling, and falls back. It rallies again, he sells again. This creates what appears to be a consolidation or a period accumulation to the untrained eye. The crowd interprets the tight trading range as bullish. The stock is holding its gains. Big buyers are accumulating for the next leg up. This is precisely the misinterpretation the composite operator desires. The invisible wall differs fundamentally from legitimate resistance zones. Historical resistance forms at prior supply areas where previous holders wish to exit at break-even. But the invisible wall appears where no such history exists. Its location is determined not by past price memory, but by present distribution requirements. Watch for these repeated tests with expanding volume but contracting price movement. Count the number of times price approaches the level and fails. 3, 4, 5 attempts, each meeting fresh selling. The composite operator is systematically transferring his holdings to the public. When you see this pattern develop, understand what you're witnessing: not a bull flag or consolidation preparing for breakout, but a carefully orchestrated liquidation that will end badly for those holding positions when the distribution completes. The tape tells the truth if you learn to read it correctly. The relationship between price and volume is the most revealing aspect of market behavior, yet it remains the most misunderstood by the speculating public. I cannot emphasize this strongly enough. Volume alone means nothing. It is the comparison between volume and price movement that unveils the true character of the market. Let me illustrate this principle with precision. During a healthy markup phase, when genuine demand exceeds supply, a stock might advance from $50 to $55 on 300,000 shares of volume. That represents a 10% gain on moderate activity. This is normal, efficient price discovery. Buyers are willing, sellers are scarce, and price rises naturally to find equilibrium. Now observe what occurs at the invisible wall. The stock rallies from $55 towards $60, and suddenly 500,000 shares trade in a single session, yet the closing price shows a mere 50-cent advance. Volume increased 67%, but price gained less than 1%. The following day brings another 450,000 shares, and the stock closes 30 cents higher. The third day, 520,000 shares, price unchanged. What is the tape telling you? The crowd sees heavy volume and makes a fatal assumption. Big buying is occurring. Institutions are accumulating. They rush to purchase, fearing they'll miss the next advance. This is exactly backwards. Heavy volume with minimal price progress reveals not buying, but absorption. The composite operator is selling massive quantities into the demand created by the public's enthusiasm. Consider the arithmetic carefully. If genuine buying pressure were entering the market, why would 500,000 shares produce only a 50-cent gain when 300,000 shares previously produced a $5 gain? The mathematics are irrefutable. For every enthusiastic buyer, there stands a determined seller. The difference is that the buyer believes he's getting in early on a breakout, while the seller knows he's distributing to a fool. I've taught my students to maintain a simple ratio: divide the day's volume by the price change. During the healthy advance, 300,000 shares see $5 equal to 60,000 shares per dollar gained. At the invisible wall, 500,000 shares, 50 cents equal to 1 million shares per dollar gained. When this ratio expands dramatically, when it requires exponentially more volume to produce the same price movement, you are witnessing distribution, not accumulation. The professional operator recognizes this immediately and acts accordingly. He begins lightening his position if he hasn't already. He certainly doesn't add to it. The amateur, reading the same tape, sees confirmation of his bullish thesis and increases his commitment. This is why the amateur loses and the professional profits. Volume divergence doesn't whisper, it shouts. But you must train your eye to see it and your mind to interpret it correctly. Watch the ratio between volume and price movement. When volume explodes but price stagnates, the composite operator is distributing his line. The invisible wall stands before you, and only supply, vast, overwhelming supply, can create such resistance to upward movement. Exit your position. The crowd is buying what the smart money is selling. Understanding the composite operator's distribution methodology is essential to survival in the stock market. This is not theory, this is the practical reality of how large interests liquidate positions they accumulated at lower prices. Place yourself in the position of the composite operator for a moment. You have spent weeks, perhaps months, accumulating 500,000 shares of a stock between $40 and $45. You've carefully absorbed all available supply without driving price higher prematurely. Through skillful manipulation and genuine demand, you've now marked the stock up to $58. Your paper profit is substantial, perhaps $7 million, but it remains paper profit until you sell. Here lies your dilemma. How do you liquidate 500,000 shares without destroying the very market you've created? If you simply offered 500,000 shares for sale, the bid would collapse instantly. Specialists and floor traders would recognize the massive supply, and the stock would plummet before you sold even 100,000 shares. Your careful accumulation work would be wasted. Your profit evaporated. Therefore, you must employ a different approach, one that requires patience, discipline, and understanding of crowd psychology. You create demand. You allow the stock to rally on relatively light volume, perhaps from $56 to $58. This attracts attention. Speculators notice the move and begin watching. Market letters recommend the stock. Chartists see bullish consolidation. As interest builds, buying orders begin flowing in first tentatively, then with increasing enthusiasm. Now you have your opportunity. As these buyers enter, you sell to them. Not all at once, that would still overwhelm demand, but systematically. You sell 50,000 shares into the rally, and price stops at $58. The buying enthusiasm has been absorbed. But you're not finished. You still hold 450,000 shares, so you engineer another rally. Perhaps you cease selling temporarily and even add a few supporting bids. The stock rallies again toward $58, maybe touching 58.50 cents this time. It's breaking out, the crowd exclaims. More buying orders arrive. You sell another 75,000 shares into this enthusiasm. The rally fails. Price returns to $56. You repeat this process, rally, distribute until your line is liquidated. Each rally brings fresh buyers who believe they're getting in on a breakout. Each rally meets your selling at the invisible wall. This creates the appearance of consolidation or accumulation to the uninformed. But you know the truth. You're systematically transferring your holdings to them. The beauty of this strategy, from the composite operator's perspective, is that it maintains price stability while accomplishing distribution. The stock doesn't collapse, it simply stops advancing. The crowd interprets this as bullish. They believe big money is accumulating for the next move up. They're correct that big money is involved. They're simply wrong about what big money is doing. This is why distribution periods often exhibit strong volume with sideways price action. The composite operator needs volume. It represents the buying power he's selling into. Without successive waves of public buying, he cannot complete his distribution. When you observe a stock making repeated attempts at the same price level with heavy volume but no progress, understand what you're witnessing: the methodical, strategic liquidation of professional holdings into amateur enthusiasm. Act accordingly. The most treacherous aspect of the invisible wall is the false breakout, that tantalizing penetration of resistance that appears to confirm the bullish case, only to reverse and trap the unwary speculator. I have witnessed this pattern destroy more accounts than perhaps any other market phenomenon, precisely because it exploits the trader's most dangerous emotion, hope. Let me describe the typical sequence with precision. The stock has been testing the $58 level repeatedly over several sessions, each time meeting supply and falling back to $56. Volume has been heavy, but as we've established, price progress has been minimal. The chart readers and momentum traders are watching intently their buy orders placed at $58.25 or $58.50 cents, anticipating a breakout. Then it happened. The stock opens strong one morning, trades through $58, and pushes to $58.75 on heavy volume. Breakout. The buy orders are triggered. Short sellers place their stop-loss orders above the breakout point. These stops are now executed, creating additional buying pressure. The stock touches $59, perhaps even $59.25. Everyone who waited patiently for confirmation is now buying. The crowd is euphoric. This is precisely what the composite operator desires. Into this burst of enthusiasm, he unleashes his remaining supply. Within 30 minutes, the character of the tape changes entirely. The stock stops advancing despite continued heavy volume. Then it ticks down: $59, $58.75, $58.50. By midday, it's back at $58. By the close, it settles at $57, leaving a long upper shadow on the daily chart. The breakout has failed completely, but observe what has been accomplished from the composite operator's perspective. He has sold to every breakout buyer, captured all the short covering, and exhausted the buying pressure that had been building. Those who bought the breakout are now trapped with losses, and their subsequent selling will provide additional downward pressure when he's ready to mark prices lower. The professional trader recognizes this pattern after the first or second failed breakout attempt. He doesn't need a third or fourth confirmation. When price penetrates resistance on heavy volume but cannot hold the gain when it closes back below the breakout point, the message is clear: distribution is occurring and the next significant move will be downward. The amateur, however, interprets these failures differently. After the first failed breakout, he thinks just a false start, the next attempt will succeed. After the second failure, it's building energy for a bigger move. After the third, when it finally breaks, it's going to explode higher because of all this consolidation. This optimism is precisely why the amateur loses. Each failed breakout should diminish confidence, not increase it. Each failure reveals additional supplier overhead. Each reversal demonstrates that sellers are more aggressive than buyers. I teach my students a simple rule. After 2 legitimate breakout attempts fail at the same level with heavy volume, exit all long positions immediately. The invisible wall has been confirmed. The composite operator is distributing, not accumulating. What appears to be a coiling spring is actually a trap being set. The tape has given you fair warning. The question is whether you'll heed it or join the crowd in their optimistic delusion. Professional traders read these signals and act. Amateurs ignore them and suffer. The market rewards those who observe carefully and act decisively on what they observe. What follows the completion of distribution at the invisible wall is perhaps the most psychologically devastating phase for the uninformed speculator. I describe it without pleasure, but with the earnest hope that understanding this phenomenon will spare you the experience of living through it with your capital at risk. When the composite operator has successfully liquidated his entire line, when he has transferred his 500,000 shares to the eager buyers who purchased at $56, $57, and $58, remarkable transformation occurs. The support that seemed so solid during the distribution phase vanishes, as if it never existed, and in truth, it never did exist. What the crowd interpreted as buying support, those bids at $57, 50, 50, 50, $6 were merely the composite operator's method of maintaining price stability while he distributed. He needed the stock to hold steady to attract buyers. If it had declined during his selling, the crowd would have grown suspicious and demand would have evaporated. So he supported the price artificially, using perhaps 10% of his position to hold up the market while distributing the other 90%. Once distribution completes, this artificial support is withdrawn immediately. There is no reason to maintain it. The composite operator has achieved his objective. He has sold at favorable prices. Now, market forces operate naturally, and those forces are entirely one-sided: supply without demand. The decline begins innocuously. Perhaps the stock closes at 56.75 one day, then 55.50 the next. Just a normal pullback. The crowd reassures itself. It consolidated at 56 to 58 for weeks. Surely that's now support. They add to positions, averaging down, confident the stock will return to the recent range. It doesn't. Within 5 to 7 trading sessions, the stock is at $52, then $48. The decline accelerates because there are no genuine buyers, only trapped holders hoping to exit at break-even. Each bounce brings selling, not buying. Every rally attempt meets immediate supply from those who bought at higher prices and desperately wish to minimize their losses. I've observed stocks retrace 60%, 70%, even 80% of their entire advance in a fraction of the time it took to rally. A stock that required 8 weeks to advance from $45 to $58 may return to $48 in just 10 trading days. The mathematics seem impossible to those experiencing it, but the explanation is simple. The advance was supported by the composite operator's buying and manipulation. The decline is driven by pure selling pressure without any professional support. The amateur realizes his error too late. At $52, he's hoping for a bounce to $56 to exit with a small loss. At $48, he's holding desperately, unable to accept the magnitude of his mistake. At $45, he finally capitulates in disgust. selling at precisely the level where the composite operator initially accumulated and may be accumulating again. This is the complete cycle: accumulation, markup, distribution, markdown. The invisible wall represents the critical transition from markup to distribution. Once you recognize it forming, your course of action is clear and immediate. Liquidate your position. Do not hope. Do not wait for one more rally. Do not average down. The professional exits during distribution, accepting his profit. The amateur holds through the collapse, converting a winning position into a substantial loss. Study the tape, recognize the warning signals, and act decisively when they appear. Your capital depends upon it. Gentlemen, I have laid before you the complete anatomy of one of the market's most dangerous traps, the invisible wall. This is not theoretical speculation. This is the documented, observable behavior of markets under the control of the composite operator, repeated in stock after stock, cycle after cycle, for as long as markets have existed. The invisible wall reveals itself plainly to those who know what to observe. Repeated tests of the same price level with expanding volume but minimal price progress. The mathematical impossibility of heavy trading producing negligible advancement. The methodical engineering of rallies designed to attract buying. The false breakouts that trap the optimistic and trigger stop losses. And finally, the devastating collapse when artificial support is withdrawn. Every signal I've described appears on the tape in real time. The information is not hidden, it is simply ignored by those who prefer hope to observation, theory to practice, and fantasy to fact. The choice before you is straightforward. You can approach the markets as the crowd does, responding emotionally, interpreting heavy volume as bullish confirmation, buying breakouts without question, holding positions based on hope rather than evidence. This path leads inevitably to losses, frustration, and eventual abandonment of speculation altogether. Or you can approach the markets as the professional does, studying price and volume relationships with rigorous discipline, recognizing distribution patterns when they form, acknowledging warning signals even when they contradict your desires, and acting decisively to protect your capital. The composite operator cannot operate without leaving evidence. His very size prevents concealment. The volume required to distribute 500,000 shares cannot be hidden. The price behavior at the invisible wall cannot be disguised. The failed breakouts speak with unmistakable clarity. You need only train yourself to read what the tape is telling you. I began my career believing the market was random, unpredictable, governed by forces beyond comprehension. Decades of careful observation have proven otherwise. The market operates according to definite principles. Large interests accumulate when pessimism prevails and prices are low. They mark prices higher through skillful manipulation and genuine demand. They distribute when optimism is widespread and the crowd is eager to buy. Then they mark prices lower, preparing for the next cycle. Your success depends not on predicting the future, but on recognizing present reality. When the invisible wall forms before your eyes, when volume surges but price stalls, when breakouts fail, repeatedly, when the mathematics of price and volume reveal absorption rather than accumulation, act immediately. Exit your position, preserve your capital. Wait patiently for the next genuine opportunity. The market will always provide new opportunities for those with capital intact and judgment unclouded by losses, but it shows no mercy to those who ignore its warnings. Study the tape. Trust what it tells you. Act upon what you observe. This is the foundation of successful speculation, and it has been proven reliable through every market condition and every generation of traders. The invisible wall is real. It will appear again in stocks you own or are considering. When it does, you now possess the knowledge to recognize it and the wisdom to act accordingly. Use this knowledge well. Your financial future depends upon it.